Hey folks, David Frost, My Strategic Forecast. You're here for another episode of Common Sense Market Analysis. Today is Tuesday, September 15, 2015. All right, let's get into it. Let's find out where we are and where we're going. So today we obviously came right up into the top of this downsloping trend line, the top of the triangle. You can see here where the market pierced through it and closed below this point here. Now, here's the important stuff. I'm going to make this as simple as possible. It's pretty cut and dry. I wish I can tell you exactly where the market's going to go. There's too much stuff going on. You got the Fed. You got a potential short covering, panic buying rally that could ensue if we get, well, let me explain why that would happen or how we know that's happening. So here's the story. As it stands now, I'm pretty sure, okay, that the market's going to get up and probably pierce through this 200 level here, which is basically $1.50. Let's just call it, for round numbers, we'll call it $2 higher on the spider, and we'll say, 250 cents is probably going to happen tomorrow, if not Thursday at the latest. Now, if we close above the high of this red candle here, which is 199.47. That changes the picture. Okay, so what I'm saying is that intraday tomorrow, I'm actually expecting the market to pierce above the 200 level, and I'm going to give it, let's just say, 50-cent wiggle room. The catch is, where do we close the day? If we're going to close, or during the day, if we begin to trade hourly, hour after hour after hour, above that level of, what was it again, 199.47, okay, then the market is prone to get that vacuum going to the upside, and you'll start to see a lot of short covering, panic buying, rumors about the Fed, all kinds of stuff. Just throw everything in the pot, mix it up, and whatever comes out, comes out. So if that happens, then I'm going to suggest that there's a high likelihood, you're going to see a lot of resistance at 202, but there's a high likelihood that we go and fill this gap at 204. And that's predicated on a close above this day here, which is on the 9th of September, okay? Now, on the wild card, right, the outside chance that the market keeps going somehow, some way, okay, we could actually get up to, well, let me redraw that. I don't think it's going to get to 210, but I do think it could get to, let's just say 209. That's possible, okay? It's not probable. It's possible, all right? That's on the wild card scenario. What that'll do is that will suck all the final retail traders right into the market, and that will be the final top. Good night, Irene. Okay? But I don't think we can get up that high unless we gain a lot of momentum. You've got to have the volume to get up there. Okay? The likelihood of us getting up there this week without volume is slim. If we get any volume, which would be a short covering rally in earnest, okay, and we just bust through these levels here, if we bust through 203.97 with conviction, then you're gonna take a run up to this level right here. That's basically where you're looking at. But that's the wild card scenario, okay? So the likely scenario is tomorrow we're probably gonna pierce 200, all right? So let's just do this. Tomorrow, my odds say we pierce 200, all right? 200.50, all right? If we close above that level, or if we begin to close hourly above that level and the market's strong and we're in a uptrend, on a daily uptrend or intraday uptrend, then you're going to go to 202, and if it keeps going, you're probably going to fill this gap. This is what I was talking about over the last few weeks, the last few days. This is you're on a ship in the ocean, you're in the front end of the storm, all right? And you've got to ride it out if you're short, right? And I've got some shorts out there. I'm okay. I get it. I somewhat expected this to happen. I was prepared in case it didn't happen and the market failed. Okay, I didn't want to be left out left out of the party if the market broke to the downside of this triangle, right? I don't want to be the only guy, left without a date at the party. But I'm prepared for if the market continues higher, and I will add again. I will put on more shorts, and I'll add to the SPXU. I have no problem doing that. I've read this book before. I've been to this rodeo. A lot of you out there have as well. This is the way it works. The market is designed to fool the retail trader. It's designed to do the thing that it's not really going to do first before it does the thing it's ultimately going to do second. Okay? And I know I say that a lot, but it is what it is. And I repeat myself because I want to drill it home that this is still in a downtrend. And if we spike higher, that the only thing that means is it's more short covering that happens. And you see, remember the other day when I said I don't like the setup because the sentiment was too bearish. And that's exactly what's happening here. When the sentiment is too bearish, it's not necessarily good for the downside behavior, right? If the sentiment is extremely bullish, I want to be looking for signs of a top. If the sentiment is bearish, I want to be cautious on the downside because, and certainly, a lot of times, understand this, the biggest down moves have come in oversold markets. And that's why I was reluctant to sell the short position or the SPXU because I'm aware that it's like a rubber band. And I've used this analogy before. So you stretch a rubber band, you stretch a rubber band, you stretch a rubber band. And that's what happened down here. All right, let me just do this with you. Down here, the rubber band was stretched pretty tight, pretty wide. And it was either going to do one of two things. It was either going to break, okay, and go lower, or it was going to snap back, okay, and get back into somewhat of a, relieve the oversold condition, if you will. And that's what happened. So the same thing could have happened here, okay, like for example, this day down, okay, all of a sudden you get an intraday oversold condition. If we had another down day like that, that could have caused a cascade effect and we could have cascaded lower, forgetting about the oversold condition, and the market could have broke that rubber band and really scaled to the downside. So you really don't know exactly what's going to happen. The only thing I can do is I can use all the tools at my disposal to give you and myself the highest probability scenario. But you heard me say a couple of times last week and probably even yesterday, I don't like the bearish sentiment. I don't like the fact that the sentiment was so bearish, okay? But right here, this is your first level of defense. If you can close the day above this level right there, all right? Right here. You get a close above here, okay? And then there's more upside coming. What that's going to do is it's going to trigger institutional buying. Okay, because what they're gonna do is the buy programs are gonna hit, and those are automated programs. They're basically hitting a button and they're saying buy the market. They're buying the spiders and they're buying all kinds of stuff. The buy program hits. The retail traders see the market scaling upward. They call their broker. They hop on. They say, "We're missing it. We're missing the rally. You took me. You put me in some cash. I don't want cash anymore. I want to be back in." So they start buying stuff. They don't even care what they're buying. They just say, what are your analysts like? So they throw out a few names. They go, all right, buy me 500 shares of this, 1,000 shares of this. Next scene shows the market's up at 204 or higher, and that's the end. And that's the way it works. Okay, the retail trader is going to be the last guy in. It happens over and over and over again. Nothing's ever going to change. Human behavior just keeps continuing to do the same. Humans, we keep doing the same thing over and over again. It's human behavior. It's the way it works. All right, enough on that. In terms of the IWM, the IWM lagged for most of the day. It wasn't like down. It was just lagging the S&P, but then it kind of caught up and finished up 1.3%. And the SPY was up 1.4%. So really, there's nothing to see there. It's still overall, might as well just bring it up. Overall, it is the lagging index, but you can see it's really fighting this downsloping trend line. And if we can close above this trend line, and confirm, and the confirmation is really going to be, a following close above the trend line, really 2 days in a row, making a higher close than the prior day. If that happens, then you're probably going to take a run at the 50-period moving average up here at 119.5. Okay, but there's still a lot of work to do to get there. But we'll see. It's still the lagging index, and this is still a bearish pattern by all measures. I mean, look, this is actually forming a bearish wedge. Okay, that's even worse, okay, because the fall can be very dramatic off a bearish wedge. All right, so that's the IWM. But on the flip side, okay, it was a mixed bag out there. The transports were strong. Now we're back above the downsloping trend line. And remember what I told you, if the transports caught a bid, you were going to take a run at 5,300. And here we go. It's 81.63. I said 5,100, 8,300. Okay. And that seems to be where we're headed. So if the spiders go, obviously the transports will go too, and you've probably got another $150 up on the transports, about the same upside as you had today, which will be about another 1.5%, 1.6% on the transports, right up into this area over here, where I'll draw it in, right up into this zone here. Okay, that'll be your area of resistance on the transports. Okay, so you got kind of a mixed bag going on here. You have the market trying to relieve most of the oversold condition, and that's actually a good thing, believe it or not. In fact, it's kind of like, the higher it goes, the harder it's going to fall. And the way I'm looking at it is, the higher we go here between now and, let's say, Thursday, maybe even Friday, maybe even after the Fed announcement, maybe we start to come down next week. We'll see. Okay, but I'm anticipating running up into the Fed announcement, and we'll see what happens. I don't care what they say. It's all about the market reaction. And when I'll talk about it tomorrow again, but just in case I fail to mention it, if you're trading in and around the Fed announcement, remember, okay, you shouldn't have a position in front of the Fed announcement. That's really just a guess. What you do is, you kind of have to know, and if you go back to all the Fed announcements, the first move that the market makes is generally the wrong move. So the Fed makes their announcement, they say whatever they're going to say, the market spikes in one direction or the other, and in my experience, 90% of the time, that first move ends up being reversed 90% of the time. That's from my experience. Go do your homework and kind of see where I am on that. Go back to the days the Fed had their announcements, pull up an intraday chart, and you'll see for yourself. Don't take my word for it. Go do the homework and you'll see. The first move is generally the wrong move. Okay, let's move on to gold. Gold struggled a little bit today. I don't love the fact that we're making this bearish pattern is continuing, right? That's not necessarily what I want to see. But what you have to realize is, and I know you realize this, but what we have to realize is that all these markets are going to whip around and spike in one direction or the other on Thursday. That's just the way it works. So you got to expect some kind of quiet behavior in gold. My guess is quiet behavior even tomorrow. It was down $3 today, but that's not necessarily bothering me. I don't love the fact that it's below the 1105. But at this point, I'm going to be in for the Fed announcement. That's just what I've decided to do. And if I'm wrong, I'm wrong. I will pay for it. If I'm wrong, if you're not comfortable, if you're long gold and you're not comfortable being in and around, in for that trade in and around the Fed announcement, then move out. It's just, you have to do what you're comfortable doing. Unless something crazy happens today, I tend to think that. I still think based on all this behavior in and around here, I think they're just trying to shake out the longs. And if I'm wrong, I can accept the fact that I'm wrong, but I've got pretty good conviction on this one. But I don't have, necessarily anything other than what my cycles are telling me we should be higher, later this month. We should be higher in November, and that means to me that we should be higher between now and November. Okay, I don't expect gold to sell off $100 and then bounce back to November. So the cycle is the cycle, and my cycles have treated me fairly over the years, and until proven otherwise, I'm going to trust the cycle on this one as well. So we'll see. I'm hoping right here, and hope is not a strategy, but this is what I'm looking at. It's a low and a higher low, and I think we're putting in a higher low, and that's what my belief is right now. And let's move on. The bond market. So the bond market didn't even give us a chance to take a short up in this zone here that we talked about last night, what it's doing. And we talked about this last night. If the bond market got up to this area, that would be a shorting territory. But guess what? The bearish pattern decided to play out anyway. And we've been talking about this pattern for days and days and days. And here it is playing out. Now look at this. Is this market symmetry at its finest? So you have this big red candle here. You chop around sideways for a couple of weeks or so. And then what happens? The next move down all in one day is around the same length or the same amount as the first move down on this candle. Not the first move down from up here, but just this particular candle was actually mirrored right here today. And I find, that in and of itself is fascinating to me. And what did you do? You found support at right in around this low here, okay, from this down day, but you closed below it. And let me just double check that. The low here was 153.29, okay, and the close today was 153.24. So you closed below that low. That's bearish. You'll have some chart support here at this low, okay. And then after that, it's just I am in the camp of longer term, lower bond prices, higher yields. Let's flip the chart over, because for the last couple of days I haven't shown you the yields, but we've been looking at the yields lately, and look what we have here. Same thing, it's just flipped over, okay? This is what we were looking at. An up move, sideways consolidation, and another up move. And this is the 10-year note. And the 10-year note, you're going to find some resistance in between 235 and 240 in this zone. Okay, so call it 275, right, for argument's sake. In this zone is where you're going to find a lot of resistance, all right? And you'll find some resistance here at these pivot highs, this pivot high here. But make no mistake about it, in my work, okay, this is a longer term trend developing. While this is the daily chart, okay, let's go back to the, let me go to the continuous bond contract, okay, the long-term continuous bond contract, so we can look at what this looks like, because I think it's worth a discussion for the new members, okay? What you have here on a monthly basis is, in my belief, a top was put in up in this zone here, okay? This is a top, this is a high, and I believe that this is a lower high. This is a reversal candle, and on a monthly chart closing basis, which this was last month, okay, that's a very bearish development. Unless we can reverse that and go up this month, okay, my contention is that we're putting in a lower high. Let me go back to the weekly chart and I'll show you a little bit of a different look, okay? So on the weekly chart, you have a high, a lower high, a lower high. 3 lower highs is very bearish on a weekly chart basis, okay? And you can see the market struggling. What you did here today is you came back in to last week's test of the 20-period moving average, okay? This is the 20-week moving average. A close below that is generally going to bring you, not necessarily immediately, but towards the 200-period moving average. In the world of bonds, 153.24 to 149 is a big move. Let's look at it on a daily chart basis so you can get the different kind of visual, okay? So if I squeeze this together, all right, well, I don't need to go that far. So you can see that on a daily closing basis or a daily chart basis, from where we are down to 149 is a pretty good move. You're going to start testing these double bottoms from down here, okay? That's what you're going to end up doing. And this is very bearish for bonds, bullish for yields, and you know the conversation in terms of the economy and higher yields. It's not about the Fed. The 25 basis points or whatever they do, maybe they raise 12.5 basis points. Maybe that's how they surprise everybody. Who knows? But that's a bank-to-bank lending rate. That's not what we're discussing here. What we're discussing here is the long-term impact on the economy of higher interest rates. Let me do this. And I'm harping on interest rates because I think it's important to understand what we're really talking about here and the impact. Remember when I showed you, and I don't have the chart handy, but if you weren't here, what I showed a while ago, a couple of weeks ago, it was a chart of a long-term, it was like a 200-year chart of the bond market in yield terms. And you can see that we're at the lows of 3% on the 30-year yield, okay? So let me just go bring that up while we're talking about it. So we're basically, when I brought that up, we were down here at like 3%, okay? And if you retrace the long-term it's been 34, 35 years since we hit a high in yields back to basically 1981, okay? And if you that's a Fibonacci level. 34 years is a very important Fibonacci number. We made a low in bond yields 34 years before we made a high, or it was actually, I think it was between 34 and 35 years before we made the high in 1981, and now we've come down for 34, 35 years in that neighborhood. And so my expectation is that 34-year plus Fibonacci cycle is still in effect. And if we retrace just even a third of that, it more than doubles the interest rate from where we are now. That can have a devastating impact on the economy. And that's the point I want to get across, specifically to the folks that didn't get a chance to see that chart. And I think that chart is published on my YouTube channel. So go ahead and find it. You'll find it within the last couple of weeks. It's a bond-related YouTube video. I think it might have even been published on a weekend. So look for a Saturday or Sunday type of publishing. You'll find it. And if you don't, email me and I'll show you where it is, or I'll send you the link, whatever it is. Okay, enough on that. Let's go over to the oil market. And the oil market whipped around today pretty good, but guess what? Let me blow this back up a little bit. Here we go. What we did today was we whipped around and we ended up keeping the bullish pattern intact. And this also is another indicator that if we're going to see higher prices in oil up to the $50, maybe $50.50 level, if that's going to happen, okay, then that's going to coincide with a higher stock market. You're not going to see higher oil prices without the stock market getting pulled along, or vice versa, okay? It's very unlikely to see one go without the other at this juncture in time, all right? But once that does happen, then this becomes a stone cold short, all right? If we get to $50, $51 in the price of crude in that zone, so I'm not long oil, I'm not going to play it up to that level, but if we do get up to that level, it's a stone cold short, okay? So if that's going to happen, it could very well begin happening right now. So we'll see what happens over the next day or so. If we can see another couple of dollars spike, that could also cause a short covering rally in oil because there's a lot of folks short oil as well. That's about it. There's really nothing new, no new development in oil based on what I've been talking about the last couple of days. Let's go to the dollar. So the dollar, as you know, we've been talking about a bullish pattern in the dollar, and we came down and we tested my 95 20. What was that level again? I always forget that level. Forgive me for that. Let me just blow up the chart so I can see what that level is. You probably know what it is. I just can't remember. 95.20. I've got so many numbers in my head. They just they go around and around. So 95.20, we came down and tested that yesterday, and now today we went up into the 20-period moving average. And, you know, this is a bullish pattern. And this was nothing other than a pullback pattern, right? Right into the number, and now we're headed up again. I expect higher prices in the dollar. So I am very, very convinced that this low will not be taken out. However, be careful this week, because with the Fed announcement, you can see some gyrations in the dollar. But if we start to see a move higher in earnest, specifically close above this level here, then I think the move is beginning. And I think it's going to begin around this time frame. And when I say the move is beginning, and this is for the folks that haven't seen this too many times, this is an ultra, or I should say uber bullish pattern, okay, on a long-term monthly chart. Okay, this chart's going north of 105. Make no bones about it. It's just a matter of when it begins, and that's really just the only question that's unanswered at this point. But this is a very, very nice pullback pattern, and today we had a nice up day, and that tells me that this bullish pattern is intact, and we're going to see follow through to the upside, higher prices coming. Natural gas, little pullback today. All we did today was basically retrace about half of yesterday's up move. And if we want to just confirm that on an hourly chart, you can just see that. You know, here's where we were at the low. I didn't even do the Fibonacci retracement, but I can see it with my, naked eye here. That's half the move. I mean, that's pretty obvious, right? Why don't we do it for fun and see what it is? What a shocker. Half the move. Okay, so that's pretty obvious. That's normal market behavior. Longer term, we're bearish natural gas. Shorter term, we can certainly see higher prices in natural gas. I would find it hard to see natural gas go higher in the face of a higher dollar. We went into the 50-period moving average, but remember what I said yesterday. We were going to have to close above the 50-period moving average, and specifically above this level here, okay, in order for us to challenge the 200 and get up into this zone here that I talked about last night, this purple line. Okay, that didn't happen. The 50-period moving average rejected natural gas. So until and unless we close above these levels, this doesn't come into play. I hope everybody understands that, and I hope I was clear about that last night. This is meaningless unless you can close above this red bar high here. Okay, that's, the number is 279.2. Okay, so unless you get a daily chart close above 2.792, this is not in play up until that point. So hopefully I was clear last night, but I know I'm clear now. So the 200-period moving average, the 50-period moving average rejected natural gas. So therefore you got a 50% retracement, but that doesn't mean it's going right back down. Okay, a 50% retracement is a natural pullback. We have to see what happens from this point. So what are our options? We could fail and get back to the downside underneath the channel. That would be extremely bearish. Or we can make a bullish consolidation pattern like this, okay, and build pressure or build energy for a move higher, okay, and see what happens from there. And if that happened, if we got another 3 or 4 days of sideways movement, then you would say the odds begin to increase that you're going to go out and challenge and close above this high here. Okay, that's just the way it works. Okay, so I think that about covers everything that I needed to tonight. Hopefully it's helpful. I'm David Frost, My Strategic Forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.